marketing, operation and sales department to ensure all perspectives are considered. The third is estimating the cost and return. You are starting up your business, also you need to estimate your cost. Because when you estimate your cost, and also you're going to know how much you're going to inject in that business. Also you have returns. Returns are now what you're going to generate from that cost. And returns are income or revenue in a business. We have applying capital methods also. After you estimate the cost and returns, so also you need to apply capital budgeting method. And there are many techniques or methods of capital budgeting. So we have the first one is net present value. So when you choose the capital budgeting method, so you're going to also, because capital budgeting methods are going to help you to estimate the cost and return. And manager applies specific capital budgeting techniques to evaluate a project quantitatively. Common methods are net present value, internal rate of return, payback period, profitability index, counting, and so on. These techniques provide a structured way to compare the project and assess which one will generate the highest income. When you put all these methods in place, you need to identify which method will hand you the highest income. Then you choose that one. Because there's no way that they're going to choose the method that is going to generate you with the less income. Also, you choose the best investment options. Once all analyses are complete, the company selects the project that meet evaluation criteria and aligns with strategic priorities. Timing and also resource availability often influence these studies, especially when multiple projects compete for the same fund. Allow me to also talk of capital budgeting methods. So capital budgeting methods help business to evaluate, compare, and select investment based on financial viability and risk. Companies often use multiple methods to ensure the best decision. And here are the examples of capital budgeting methods. The first one is payback period. Payback period method measures the time it takes for a project to cover its initial through cash inflow. You start a business, also you need to know that you set that time. This method helps to estimate the time that you're going to recover the money that you have injected to your business. Take example, you injected 500. You injected 500,000. Or this is the money that you have started your business with. You need to calculate and see the duration. For how long? You see the interval of years. For how long are you going to cover this 500,000 that you have injected or that you have started your business with? And the formula of yield says initial payback period is equal to initial investment divided by annual cash inflows. So you have injected 500,000 into your business, but every year you are gaining 100,000 as what? As your income. You need to take the initial money that you spend, divided by the money, the annual inflow, okay? Cash inflow, which is 100,000. 500,000 divided by 100,000, you're going to find that payback period will be 5 years, right? This is initial money that is injected into your business is 500,000. Then every year you're what? You're gaining what? This what you're gaining every year, which is 100 years, 100,000. So you need to see the interval of time that you're going to what? Recover this money that have been injected into your business. Whereby the formula says pay back period is equal to initial investment all over cash inflow. So here we have this one is our initial investment and this is our cash inflow here. This is our cash inflow. So we need to find the years. For how long are we going? On the interval of time that we're going to cover this money. So you divide 500,000 all of the 100,000. So when you divide by this one, you're going to get how many years? 500 years. Which means after 5 years, 5 years only. 5 years. Which means, okay, within this interval of 5 years, we're going to cover this 500,000 that you have injected into your business. Also, there is a method called discounted payback period. Discounted payback period is similar to payback period and incorporates the time value of money and also the discounting feature cash inflows before calculating recovery time. So, because of time, allow me to look at the advantages and also disadvantages of
Good conclusion.
Okay. So, about the advantages of capital budgeting, we have forecasting. So, capital budgeting helps companies focus or predict or track cash inflows and outflows tied with the major projects. This allows business to anticipate funding needs and avoid liquidity crash and plan financially strategic well in advance. Also improve transparency and accountability. Another advantage of capital budgeting is avoid overinvestment or underinvestment.
Conclude.
Also build investors and stakeholders confidence. Limitations of capital budgeting or disadvantage of capital budgeting. We have inaccurate cash inflows estimates. Sometimes we say that this deals with estimation. Sometimes when you estimate more than the money that you're going to earn, this one will be also a disadvantage here. The accuracy of any capital budgeting decision depends on estimating future cash inflows and outflows. Overestimating revenue or underestimating costs can cause projects to look more profitable than they really are, leading to the poor